All right, we're live. Thank you so much for joining me. You're watching Be the Boss of Your Money with Mitch Goldberg. And guess what? I'm Mitch Goldberg, if you haven't figured that out. Hey, we've got a good show today, a nice quick show. We're going to move it along. This is a huge week for news. For the last few weeks, we've been contending with earnings announcements. So we had a good three and a half weeks of earnings, of what CEOs and CFOs have to say about the rest of the year, about the current quarter. Uh, the result is that earnings are still on the high side. The result is that earnings should be revised downward. The result is that consumers are feeling the pinch of inflation, but they're still spending like mad on experiences, going out to dinner. That money is being taken away from spending on apparel and electronics. So that's that. But now we're going to hear from another entity. That's the Federal Reserve. They have their congressional testimony. It used to be called the Humphrey Hawkins testimony, but now I think it's just called the congressional testimony, where the Fed speaks in front of Congress tomorrow and Wednesday, and the Fed will be clear about its or will update its views of inflation, of interest rates, of the economy, of employment, lots of things. There are going to be a lot of politicians that are going to be grandstanding, asking questions with a very angry, overly animated tone because it's a good moment for social media and for C-SPAN and all that. So you're going to get a lot of theater. So I want to encourage you to look past the theater and focus on the substance of what Federal Reserve Chairman Jerome Powell has to say about everything going on. That will serve you much better. Okay. So, and then I want to talk a little bit about Social Security. That is a topic that we cover a lot here on Be the Boss of Your Money. And that is what we're going to talk about. So let's roll the quick intro. And I will be back in 15 seconds. Stick around. This is going to be a good, quick show. While you're watching, if you don't mind, whether if you're watching in replay or in the live, give us a thumbs up. It helps spread the word, the good word about what we're doing here, all education, financial literacy, markets, updates, perspective. Help spread the word to the rest of your contacts. We always appreciate it. Great way to show support for this show. And if you have any questions about what we're talking about now, words of wisdom, words of encouragement, that's what the comments are for. I love hearing from you. It's the best part about doing this. So don't be bashful. Say hello in the comments. Ask your question. Make your point. Let's have a little bit of debate, and it'll be a lot of fun that way. So here is the intro, and stick around. It's gonna be a really good show. Thank you so much for joining us. We're just getting started. You're watching Be the Boss of Your Money. This is a show. It's a post-market show. Gives you perspective on the day's news, the big financial news. We share a lot about personal finance, what's taking place in the world of interest rates, Social Security, borrowing, mortgages, home buying, you name it. If it has to do with money, and in my little world, in our world, everything has to do with money. So we talk about money all the time. So let's cut to the chase. Let me make a few changes on the screen, take those out, get rid of the social media icons, and pop myself up here. Okay, so the Dow continuing its winning ways. This is the fourth trading day in a row. So it was up Wednesday, Thursday, Friday, and today. 4 up days in a row, up 40 points. It was up over 180 before, so the close is kind of ugly, kind of weak. That's because interest rates started to drift a little bit higher toward the end of the day. That's the reason given for that. Although we know that the reasons for market moves are not really exposed to us sometimes for several days, months, or even years. But that's the reason of the moment. Okay, interest rates popped up a little bit after being down all day, put a little pressure on stocks. NASDAQ down 13 points. barely off, but it was up a lot more earlier today. And the S&P 500 was up 2.78 points. No big deal. By the way, you can't invest directly into an index, but you can invest into a security that tracks or mimics an index. Oil broke $80, so oil is now $80.53, as you can see. So we are definitely at the upper end of the range. It's from low 70s to low 80s. So we were at the higher end of the range. We are starting to think about the summer driving season. We are thinking about China opening up. China just had a very strong manufacturing report. So I could see global demand for oil going up a little bit. The 10-year yield closed at 3.96. It was a little bit lower the last couple of days. It drifted a drop lower. Today it finally perked up a little bit. So went from being down to being up a little bit. That, took some of the wind out of the sails of the market today. And the VIX, still no big deal, 18.61 on the VIX. VIX is hanging in there like a champ. And it's just been such a low volatile year. Let's take a look at the bond market, okay? So you see this. So 1 month, 2 months, and 3 months were off ever so slightly, but from the 4 months almost on, everything was up except for the 7 years off, the minuscule amount. That's basically flat. So we still have a 10-year at 3.9 and a 2-year at 4.86. But if you notice, the yield curve is it's not getting steeper. It's kind of not as steep. So that's a good thing. Who is out there? We have Frank. Hey, Frank, how are you, my friend? Let's go, Mitch. Thank you very much. And let's go, Frank. Oh, yeah. So Frank, one of my closest friends, fellow Long Island elitist. We're not elitist. I'm just joking. Long Island Elite. Frank is the president of my networking group, which I've been in now for probably 18 years now. Wow. Anyway, good to see you, Frank. So glad you could join us. And thank you so much. What else we're looking at? Let's take a look at some of the market movers. Merck. I want to look for companies that you've heard of. Merck was up almost 4%. That's a pretty big day for Merck. Stock went out today at $111 a share. Apple was up about 1.85%. They got a really big upgrade from Goldman Sachs. Actually, Goldman Sachs initiated as a buy. I take it the analyst who covered Apple probably left, so they got a new analyst in to cover Apple. Went back, started right off with a buy recommendation saying the stock has 30% upside. So that would be huge for a company that size, and they've got all kinds of positive momentum. Losers of the day, Dexcom, which is in basically the diabetes business. So they're down 8%. Eastman Chemical, you would have heard of Dollar Tree, down over 3%. So that's what's going on over there. Okay. So a couple of things to talk about. The Federal Reserve. I'm trying to make the show exciting, watch this. The Federal Reserve. Boom. I raised the camera a little bit. You notice? Look. Okay. The Federal Reserve does its congressional testimony tomorrow during the day. Starts in the morning, and it'll be tomorrow and Wednesday. They first go with the Frankie, LongIslandElite.com. There it is. The only website you need to know. Okay, so thank you. The Fed sits in front of Congress, the House. I think tomorrow they sit in front of the Senate, and then Wednesday they sit in front of the House. You're going to see a lot of grandstanding and people asking stuff. They're pissed off about this, or why aren't you doing this? Why aren't you doing that? A lot of second guessing. Don't focus on the noise and the bluster. Focus on the substance of what Chairman Jerome Powell has to say. He'll give us an idea of where the Fed sees inflation, interest rate trends, employment trends, and it'll give you an idea that either the Fed has more to go in terms of raising rates, remaining tight, as we say, or were they willing to loosen up? So the vernacular that we're going to hear a lot about the next few days is this: the pause. That's when the Fed stops raising rates. They pause. That is also known as the terminal rate, the rate at which the Fed feels its interest rate policy is neither restrictive nor accommodative for the economy. All right, so you're going to hear that. The neutral rate, the terminal rate, the pause. They're all basically the same thing, but we just love to throw our, language around because not everybody speaks it like we do, so we sound more sophisticated. But it does not make us better, and it does not really help you in any way. So let's dispense with the. Can I say it? Let's dispense with the bullshit. Okay. Hey, look, this isn't cable TV. It's live streaming. It's kind of you got a little more leeway. I do a radio show every day, and I'm like terrified that I'm going to drop the F-bomb. I'm terrified of it. Like at any second, I'm going to drop the F-bomb because it's just, it's the way I speak. Hey, I'm from New York. Okay. New York. That's it. What can I tell you? Frank, if you're still watching, I have dropped the F-bomb on your show a couple of times. I didn't even realize I did it until you showed me the replay. And I'm like, oh my God, I really can't believe I did that. But I digress. What the hell was I talking about? Okay, the Fed. So we're going to see what the Fed. I'm a little stuffy. We're going to see what the Fed has to say over the next 2 days, and then Friday we get the big, huge, important number, the most important number of the month every month, the non-farm payrolls. That tells you how many jobs are created or lost net. It tells you the unemployment rate. It's a huge deal. Last month it came out at 517,000. Blew the doors off of expectations. That's what turned that January rally into losses after that. Okay, that's what ended the January rally. We're expecting like 225,000 jobs created next month. I mean, for the report that comes out on Friday, that's for the month of February. We'll see how accurate it is. We'll see what the number is, and then we'll decide, is it bullish, bearish? Because right now, really good news has been perceived as bad for the market. Really good economic news means inflation is going to stay higher because if more people working, wage increases, more people spending money, more demand for goods and services, prices keep going up. The Fed wants a little demand destruction where they want to see wages cool off. They don't want to see wage growth. They want to see some layoffs. I'm not saying the Fed's trying to be like cruel and inhumane, but what they do want to see is they want to see the economy slow down a little bit so that the Fed could ease off its raising of interest rates, so it could pause, and then it could pivot, which means it could start to lower rates. And if we think the Fed's going to pivot soon, the stock market will trade well in advance of the pivot. That's how it works. It trades in advance. Let's talk about Social Security. Social Security. There are some proposals coming out of Congress, lots of proposals of how to fix it. I, for one, am very heartened that this is a priority. It's a priority in Congress. I'm very heartened that there are actually proposals coming out that are at least bipartisan in their support and their sponsorship in the Senate, which is really cool. One thing I see going around is the Fed wants to use different words to describe how you claim Social Security. So, for example, the earliest you could claim is at age 62 for Social Security, and about 35% of all Social Security claimants claim at age 62. The Congress wants you to know that there are so many people that have made the mistake of claiming early. By waiting a few years, you get so much more money every month, and it lasts. That extra money lasts for the rest of your life. So people are leaving on average $111,000 on the table over a lifetime by claiming Social Security too early. That's a statistic that's going around. Coffee time, hold on. So they want to change that to instead of saying the earliest you could claim Social Security, they want to call that the minimum Social Security claiming or amount you can get. They want to change full retirement age, which is for most of us watching this is age 67. Some of you could be 66 if you're older than I am, but 67. The Fed wants to call that standard retirement age, not full retirement age. And the age of 70, when you get the maximum benefits, the Fed wants to call that maximum benefit age. All right. Other things that I'm seeing is I thought like there was a proposal I saw to raise the full retirement age or standard retirement age to 68 from 67. But one was introduced recently, I think, like either yesterday or over the weekend or today, very recent, to raise full retirement age to 70. raise it by 3 years, and raising the amount of taxable income that people earn, because it was set up. I think taxable income for Social Security is like what, 186,000 joint, but they want to make that maybe like 400,000 or 500,000, so people have to keep paying as they make more money. That amount was set in like 1986, so it hasn't been adjusted for inflation. So that's another way to do it. So, just a few of the things that people are hoping will help shore up Social Security. It is possible that in 2033 or so that claimants could see a 20% drop in the amount of Social Security they get. I'll tell you why. First of all, Social Security is not going flat out broke. It's not that it's not going to be here. It's payroll tax into the Social Security system, half by you, half by your employer. And then that money goes out as Social Security benefits. But the Fed has a surplus of like X amount of money that they also use to pay out Social Security benefits. That extra amount is going to run out in maybe 8 or 9 years. And when that happens, there's going to be a cut to Social Security. So we need to shore up that amount now so that we could keep paying for this program. Now, Social Security came out when the average age of a person was adult American male was 65. It's really antiquated. I think you've got to raise the ages. It wasn't made to give people an income in retirement. It was made to give people a supplement, or at least a bare minimum in retirement. Okay, that's what it was for. So now I want to ask you, I want to check in with you on your opinion of Social Security, because a lot of people see Social Security as an investment. I invested into the Social Security program, and I want to make sure I get out every penny that I put in. And that's one reason why people claim Social Security at 62, 64, 66, 67. They claim it a little bit early because they want to make sure they get out of it what they put into it. That's as if you look at it as an investment, return on your capital. Other people look at Social Security as really just an income benefit when you're older. So if you wait till you're 70, well, I might not have gotten maxed out. What if you die at 74? That's not the point. If you're looking at it as a supplement to your income, you claim as late as possible. You claim as late as possible to get the highest amount you can as the income supplement. If you look at it that way, you want to claim later. If you look at it as an investment, you want to claim earlier. I don't really look at it as an investment. I look at it as a supplement to my income down the road, which is why my plan personally is to claim later than, rather than earlier. But it depends on how you look at it. It depends on your health. It depends on a bunch of things. It depends on your attitude toward your lifespan. We can't predict how long we live. I don't think it's wise to say, well, my father or my mother died from a disease when they were a certain age, or one of my siblings did. We have better diagnostics. We find out things sooner, quicker, and treat things sooner, quicker than we used to, as long as you go to the doctor and you get your checkups, get your health checked out. So I think we have to, take that part off the table for most of you. In any event, it's a complicated discussion. And if you do want to claim early, I want you to call me, because I want to see if I could shoot holes in your argument. Not to insult you, not to get you to change your mind, but I face this every single day with clients. I know an awful lot about this and what goes on through people's heads. So sometimes I get you to question yourself, your beliefs, in a good way, because it might help you step back and consider your best options. And sometimes your best option for some of you is to claim Social Security earlier, on the early side. And some of you, your best option is to not claim early. And if you need some extra income, take some money out of your IRA along the way or something to preserve your higher Social Security benefits for later on. These are the kinds of things that we talk about with clients. These are the things we help clients figure out here at Client First Strategy. And if you want to know more about us, or if you want to take this conversation on a one-on-one basis, definitely reach out to me, clientfirststrategy.com. I want to thank you for watching today's show. I had a great time. I hope you got a lot out of this, and I will see you tomorrow. Stay well.